Okay, our speaker today is one of our long-term members, Mark, and he's going to talk on his method of combining calendar spreads and some aspect of delta-based trading, 60-40-20. Let's have a warm welcome for Mark.
All right. Well, my name is Mark Mosley. I'm a longtime member of this group. And I've done a lot of work lately on calendar spreads. And so I'm here to present that. I wish they had a sexier name. People get into trading and they hear about calendar spreads, and that sounds like a whole lot of waiting. And in some ways it is, but I think if you look at these, you will find that they are very interesting. And so I'm going to move right along here. Let's see. It's not working. Okay. Before we get started, I want to throw out a disclaimer for people that are not familiar with options. You can lose big time. I'm not an investment advisor or a broker-dealer. Information presented is hypothetical and for educational purposes only. Past performance is not indicative of future results. Don't trade with money you can't afford to lose. And I highly recommend this booklet that the link is at the bottom of the screen as some introductory information. And so next. Wait a minute. How do I go backwards? Okay, here we go. Okay, this is a little bit about my background. I've been trading options for 10 years. I come to this, I used to be a commercial real estate appraiser, so I'm used to working with numbers. Currently a full-time trader doing one-on-one mentoring as well. If you make money with any of this, feel free to send me a few bucks on PayPal or Venmo. And I wanted to reference my prior presentation. Some of this discussion builds on the information in the 60-40-20 butterfly presentation. And so the link is here. We're going to distribute the slides for this, so you'll be able to get to that. But there's some good information there. I traded this 60-40-20 butterfly for about 2 years. It works very well for me, and I'll explain more why I've gone away from that. And just a trading footnote. IRS Section 1256 trades on the SPX, Russell, and NDX have a favorable tax treatment. And so I trade just the SPX. So it keeps it simple. You don't have to look at multiple instruments, but this is good information that everyone should be aware of. And for further information, consult your tax advisor. Okay. When selecting an option strategy, we need to consider how changes in volatility are going to affect our trade. Volatility moves up and it moves down, seemingly random movements. Anytime Trump tweets, volatility goes up. When I was trading the 20-40-60 butterfly, we were in a chronically low volatility environment. Nothing much was happening, and the VIX stayed around 12 to 13 for a very long period of time, and that worked fine for the butterflies as long as we didn't get a big spike, which we didn't. And so over about a 2-year period, I did very well with the 20-40-60 butterfly. But then things changed and we started getting volatility spikes. And so the trade's response to volatility is represented by the Greek vega. We want positive money flow, so we want positive theta. Delta is a measure of our directional risk. If our delta is positive, we want the market to go up. Negative delta means we want it to go down. So that was kind of a build up to the concept of delta neutral trading that we're going to apply to the calendar spreads. At any given time, the market can go up or it can go down. And you can have all the indicators in the world and still get it wrong. And so a less stressful way for me has been delta neutral trading. So we're basically bullish and bearish at the same time, and we make money off the decay of the options contracts. Okay. Negative vega trades benefit from falling volatility. And these examples are butterflies and credit spreads. And so if you think about the 20-40-60, you enter at low volatility, and as long as it stays low during the course of the trade, everything works out. But if you get a spike in volatility, you get problems. And we will illustrate that further here. Okay, so this chart shows what happens. Okay, if you're not familiar with these charts, you should become familiar with them. The normal stock chart you're used to seeing has the potential pricing on the vertical axis, and this flips it to the horizontal axis. So I'm assuming everyone can see my cursor here. So the current at the money is the center vertical line, and so this is an example of a butterfly, and I'm going to show you why these things don't always work out so well. So this is an example of the 20-40-60 butterfly. It's delta neutral at the beginning, so price can move up and down anywhere along here, and as time elapses, this line will rise, and eventually it meets the blue line at expiration. Okay, so increasing volatility tends to drop this line. Falling volatility makes it rise. So if we could enter these trades in high volatility, it would work out better than if we entered during a low volatility period. So this is what happens to a butterfly with the big gap down. And this is not even a big gap. This is a little gap down. You know, we started right in this area, and so a small gap down, and this is simulating an 8% increase in volatility, which is just a number I pulled out of the air. I mean, it could have been 20%. It could have been any number. But you see what's happened here is along our T+0 line, we are below zero at any point on the graph. And so, you know, this is an uncomfortable position. We're still under the profit tent, and you might think, oh, it's going to come back or whatever. But what if the market continues to go downhill? At this point, you're already drawn down probably $1,000 on a $5,000 trade. So you have to make a decision. Do I stay in the trade? Do I go on an exit and lose 1,000 plus? What do I do with this trade? So this is an uncomfortable situation here. And I kept putting these on and constantly getting into this sort of position where I'm not profitable at any point on the graph. Now, with enough time elapsing, this line will rise, but what do you do with this? So my answer has been to look at positive vega trades. These trades benefit from increasing volatility generally. And these are counter spreads, or some people call them time spreads. And diagonal spreads also have diagonal spreads have some of the same dynamics as calendar spreads. And so this is a calendar spread, a typical calendar spread. It's positive vega. It benefits from increasing volatility. And so as volatility increases, it tends to lift the T+0 line. Something unique to calendar spreads is it lifts the expiration graph as well. Got a question? Yes.
I guess if I can repeat the question, it had to do with different legs having different volatilities.
Yes, there are a lot of nuances, which some of which may be beyond the scope of this discussion, but I'm avoiding earnings plays because I'm just trading the SPX. But people do use these for earnings plays, and the volatility crush can be beneficial if you are positioned right in your trade. So to answer your question, yes, that's a possibility. There's a lot of nuances to the way the volatilities move because you got a short dated leg and a long dated leg, and the volatilities can move independently of each other. Now, typically, if there's some news-driven event that spikes the volatility in the market, it typically affects the shorter dated leg more than the longer dated leg. But yes, there's a lot of dynamics going on there, and I'm trying to simplify it so we can at least give you an introduction. But you're absolutely right about that. Okay, so this is a calendar spread. Now, I've simulated an 8% increase in volatility in a calendar spread, and so we got an upward shift in the profit tent, an upward shift in the T+0 line. All of a sudden, we're up big money because volatility has increased. Now, in this simulation, I have increased both the short leg and the long leg 8%. Maybe it doesn't happen like that in real life. It was just kind of an example. And you can also see it extends your break-even way to the upside and way to the downside with an increase in volatility. So let me move along here. Okay, what is a calendar spread? You've got a bullish position. When you sell a put, a short-dated put, that is a bullish position. You're also buying a put, which is a long-dated instrument. And so you're bullish and bearish at the same time. You would use the same strike price on both legs. Ideally, we want the option we sold to decay in value, while the option we bought, we want it to retain as much value as possible. And so there's a differential in the time decay. Shorter dated options decay quicker than longer dated options. And so we are leveraging that dynamic with this trade.
Sounds like you're saying you buy and sell the same put at the same strike price?
Yes, two different expirations.
Okay.
My question was, are you staying in the money or staying outside of the money?
When we start it, we are right at the money, typically. Now, the market's going to move around during the course of your trade. So your short leg may be in the money or out of the money. It's usually not an assignment risk unless you're trading very close to expiration. You'll see part of my strategy here is to trade farther from expiration. And we're getting into that here. So I made this statement, ideally volatility is in backwardation. So that would be like when there is a spike to volatility, it's usually affecting your shorter dated options more than the longer dated ones. And so that might be an optimization. You know, line 2, I said first rule, not totally necessary. I've put these things on when volatility is low, and typically it does just fine. but there's a lot of, I guess, opportunity for more research on this. But I've done it both ways. I've put these things on when we have a shock to the market. I've put them on when everything's smooth sailing. Typically, it works out either way because I'm so far from expiration. So I'm usually putting my short leg around 60 days to expiration. The long leg is about a month beyond that. These are just rules of thumb that have worked well for me. If you try to start doing these closer into expiration, you're going to get a lot more slope to your T+0 line. We really want a real flat T+0 line so the market can bounce around, move up and down. We don't know which way it's going. So if we are traveling back and forth on a flat T+0 line, we are not riding up and down the slope of something. So it's that slope up and down on a steep T+0 line, which jerks around your profit and loss numbers. So you might be up 5,000, then all of a sudden you're up 1,200, and that gets a little squirrely. So let me move along here. Okay, 60 and 90 days is the rule of thumb. If the trade is threatened on either the top or the bottom, so we're trying to blow out the top of our trade or the bottom of the trade, we'll add a second at the money calendar and manage the two as a pair. And I'm using the delta theta ratio to keep an eye on things. Yes, yes. I put on a new trade. It's making a double calendar at the same expiration. Yes, only that's. I try to avoid the earnings because I mean, it can work really well, and I've done some of that, but you know, my goal is something that works very smoothly. I like to go for a bike ride in the middle of the day. I like to take a long lunch. I like to run errands. I don't want to have to worry about all this stuff. And so this is why I've engineered it this way. There are a lot of opportunity for doing this on individual stocks. I've done a few on Amazon where I really killed it, but it's riskier. You're introducing more risk to the system. So I would suggest just stick with this on the indexes. And another thing about, I'll get to you there. Another thing about adding the second calendar. So there's several strategies for where's the money coming from for the second calendar. If you're trading with a small account, you might put most of your money into one butterfly. And then if you're threatened, take half of it off, use that half of money to reallocate into your second calendar. If you got more money, maybe you just have some in reserve, then then there's no question about where you're getting the money for the second calendar. But that's a little tweak.
Yeah, these go on for debit.
Yes.
And what is your risk? Is it just the debit?
Yes. Yes. Your risk in a Reg T account would be your margin requirement on the trade.
Based on the debit?
Yes.
Okay.
Now it would take a huge market move to wipe you out, but of course anything's possible. So anyway. Yeah, on the delta theta ratio, and I'm getting to that also. Yeah, you just ignore the plus or minus sign because okay, we're trading delta neutral, so delta could be positive or negative, and so as that number increases in magnitude either way, obviously it's a bigger number, but it would be negative on one side of neutral, positive on the other side, and so you basically, when you're calculating your delta theta ratio, you just ignore the sign on your delta and you divide it by theta. And so like for this example here, and you probably can't see that, but there we go. The delta is 0.45 to a theta of 6.97. So I just, I round a little bit. I say that's about a 0.5 delta to a theta of 7. And so we're well under 10%. Yeah, so I use about 30% is my number. If delta becomes 30% of theta, you're getting to be in trouble, and so you should probably either take profits, take the trade off, or add a second calendar spread and make it a double.
What are you going to be doing at a larger, higher strike price?
Your
lower?
second one would be at the money. So if you've got a butterfly on like this, and say the pricing has moved way up here, and our Greeks are all out of whack, and you're certainly welcome to apply some technical analysis to your stock charts, but we would have no real confidence that we're coming back down here. We would add a second one at the money way up here. And I've got a picture of one of these later in the presentation, but it extends your range of profitability on the trade. Sure. So anyway, this is a typical calendar entry, and maybe you guys know this, but your upper break even is here, lower break even is down here, and your current pricing is right in the middle. And so you put this on, and there may be nothing to do for weeks while you wait for this thing to make some money. But my experience has been that they make quite a bit of money and without a lot of worry. And so this is the same chart as the last screen, except it is illustrating the day step feature that is in Thinkorswim. This is every 10 days. A new line is drawn projecting out into the future. And so you can see how as time goes by, your range of profitability increases both on the upside and the downside, and can make quite a bit of money over time. But it's a bit slow moving. Some people prefer scalping or day trading or trading futures because it's fast and exciting. Yes. Yes, it's just a put calendar, positioned at 29.90. I just did this in the past couple of days, so that's pretty current to the market. But yeah, and so this is short the November 29th expiration, long the December 31st expiration. I'm normally keeping these on the monthly expirations, but it seems to work in the weeklies too. I like the puts better. They have more open interest. Sometimes, another strategy is to do a double calendar right off the bat. So you might position a put calendar a little bit below the money. And then if you're going to go above the money, you would do a call calendar because you don't really want to sell in the money options. Now, they may become in the money during the course of your trade, but generally I would avoid selling in the money options. So, but normally I'm just starting off in the puts to keep it simple. So let me see. And we looked at that. And then, okay, this is a discussion of delta theta ratio. Delta is a measure of our directional risk. Like we discussed already, it can be positive or negative. But it's going to bounce around. The market is going to move while you're in this trade for a month. And so delta is a measure of how far we've gone off of center. And theta is a measure of what we're being paid to take this risk. And so as a rule of thumb, this has worked out pretty well for me to look at my graph. And I actually keep track of things on my cell phone. So I can look at the delta and theta on my trade and go, oh, I'm okay, or oh, I'm not okay. So that was part of my goal, is to have a simple to manage trade that I can do stuff without sitting at the desk all day, because that gets pretty boring. So management rules aim to keep delta under 30% of theta. If trade is, we've really already talked about this, if trade is threatened either on the top or the bottom, we add a second calendar. We manage the two as a pair, keeping the delta theta ratio on the pair under 30%. Let me see. We also just want to, I like to look at the graph and make sure that we're comfortably under the profit tent. You know, regardless of what the Greeks are telling me, if I'm scared of slipping off one side of the profit tent, you need to do something. And that would be either take it off, take profits, or add a second calendar. Now, I'm trading fairly big size on these things, but you're going to see large profit and loss fluctuations during the day with minute changes in volatility is sending your profit and loss numbers all around. And so for me, it's not very unusual to see plus or minus $1,000 swings in my profit and loss. And so you might see that and get scared and go, oh my gosh, this is not fun. I'm down 1,000, I'm up 1,000, whatever. That's just the way they work. So I would encourage you to kind of ignore your profit and loss, use the Greeks to manage your trade, and everything will work out. You may never get there. If the market stays calm and stays under your profit tent, you may not get to 30%. Well, I like to get out with 30 days to go as well. So the idea here is enter with 60 plus days, and I'm referencing the short leg. Your long leg would be 30 days or so beyond that. I would like to be out with 30 days to go typically, because as you get closer to expiration, the steepness of your profit curve increases, and you can be up 10,000, up 5,000, you know, back and forth. And so we want to avoid this kind of drama, because the steeper that thing gets, the steeper it is on the downside. And so be out with 30 days.
Now, you mentioned entering this on a volatility spike when the VIX is in backwardation, right?
That may be a optimization.
Optimization.
Of this
And, but you also mentioned that when volatility spikes, the T+0 line will rise and the tent will expand. Is that correct?
Assuming your front and back leg are affected equally, which is not usually the case, actually.
So then my follow-up question is, so if it was a short-term dip and you entered when it was in backwardation, but then it shifts back into contango, what typically will happen to your T+0 line?
It should rise. If you think about it this way, you're selling the short leg, so you're collecting that premium. You'd like to get as much as you can for it. So the value of that short leg is going to increase with a volatility shock to the market. Let's just say somebody tweeted something or whatever the story is. Now, if it's something really bad, like maybe, you know, even the Saudi oil fields getting bombed didn't seem to hurt us too bad. But if it was something really bad, it would affect your long dated leg as well. And so you're buying your long leg. That's kind of an asset. Think of it that way. So you're buying your long leg. You'd like for it to retain its value. You want the one you sold to go down in value. It's just like buying or selling anything. You want to get the most you can for what you're selling. You want to pay the least as possible for the things you got to pay out for. So, yeah, the volatility with these is it's an interesting dynamic, and it can bounce all around. But you know, the thing about volatility is it it tends to be mean reverting over time. And because we're working with a lot of time on these, the minor fluctuations in the market seem to work themselves out after a few days. So anyway.
Could you repeat the question?
Okay, I was asked what would be some of the things that might trigger me to exit a position. You know, a big move in the market on big news might make me exit the position. Certainly if I am lower on the time scale towards expiration. So maybe I'm approaching 30 days to expiration, and all of a sudden something crazy happens in China or whatever the reason is. I might just get out. I might get out of the way, take profits. Hopefully I've got profits. Just get out of the way. And normally I would double up in the same expiration as long as I've got, I probably wouldn't add the second tranche under about 40 days. If it's getting that close, I might just roll on out to the next expiration. So it's a bit squirrely. You have to apply some judgment there. Well, if you're just up a shockingly amount of money, put it in your pocket. There's never a bad reason to take profits. Yes, I have been up big numbers, and I'll just go, oh, that's too juicy to leave out there. So you know, apply a little judgment in those respects. I think that would be the way to handle that.
Could you repeat the question, please?
Yeah, she asked, do I always put this on at the money, or might I project it up or down a little bit, depending on the situation? Yes, I might project it one way or another. When we are at the top of the market, like we've been recently, I'm a bit to the downside with it. Still applying the same rules, but if you were to put one on at the money when the SPX is trading at 30.30, I mean, we're not going to be at 30.70 anytime soon, I don't think. Anything's possible, but I don't think we're going to blow out the top. The risk to me is more to the downside, and so I would position it to the downside. And likewise, if we're at the bottom of the market, which would be a great time to put one on because volatilities would be higher. But yeah, you can apply a little lean to them that way. Well, I'm watching.
Question was, where do you get your volatility measure from?
I'm watching the VIX. I've got a graph in Thinkorswim where I'm graphing the VIX 9-day, comparing it to the VIX 30-day, and comparing it to the VIX 3-month and 6-month. And so if you will, I can help you set that up if you don't know how to do that, but I've got all those on the same graph, and so I can see how they interplay with each other. And if I'm seeing the short-term VIX measures elevate above long-term, you know, that may be a signal. And there's also the volatility numbers on your option chain, which you can look at too. But I like to see it graphically, and so that's why I'm looking at the VIX that way. Brian, you had one? VIX Central is another place you can find a lot of information on the VIX.
Question was, have you looked at looking for a more accurate measure of Vega?
No, I really haven't. Vega is a difficult thing to model out. There's a lot of discussion in the options trading world about how the Vegas are not accurate, and you know, you've got two different legs that can move independently of each other. One can go up while the other goes down. They can both go up. They can both go down. I haven't really wrapped my head around how to do that. That is something I'm thinking about, and I would love to do further research on that. I'm sure there's a way to optimize some of this, but great topic for further discussion. So anyway, so this is a big point here. Try to ignore your profit and loss. Let the trade work. Your profit and loss is going to bounce around. Watch your Greeks. As long as your Greeks are happy and you're under the profit tent comfortably, your trade is probably going to work out just fine. And so here we have a double calendar. And this is just one I threw together. The pricing may not, probably it wasn't right because this is just a simulation. But you can see how it has a wider profit zone compared to a single calendar. And I've projected this forward in time as well. This is December 31st. So this would be, okay, you've been in a trade for a while, then you had to add the second part on. The market's moved all around and time has elapsed. And so you would be up money, the way this thing is displaying it, over a very wide range. So there's no downside to doubling these things up. And this is a live trade example of a trade that I've got on right now. This is a 25 lot trade. Put this on September 6th, 19 days ago. And I'm up 12% on this trade right now. You know, I'm still very comfortably under the profit tent. It's still 50 days to expiration. You know, some people might say you're up 12%. You know, who wouldn't want that to put that in the bank? But I'm very comfortably under the profit tent. I really don't think we're going to blow out the top of this. You can see the upper end of this at about 30.70 on the SPX. And if you follow the SPX at all, that is like way up there. I don't think we're going that far. So I'm just watching this on a day-by-day basis. You know, if it begins to scare me, you know, I don't think we're going to blow out the top. If we even push the top, the market will probably revert back down. But this is the live trade I've got on, and I'm up 12% after 19 days. Going great. And this is the same trade projected forward to October 15th, which will be 30 days to expiration. Hypothetically, if I stayed in the trade that long, I would be up 24%. So you can see it makes a pretty handsome return. And let's see. The debit to this trade. I think this was, I really don't know for sure. I don't have that info right here. You know, usually with 60 days to go, the debits are running around $20 generally. I've experimented with longer ones, putting my short leg at 90 days. The debits are usually around $13 or $14 if you go farther out with your short leg at about 90 days. But anyway, I'm doing a lot of experimenting with them. So anyway, exit rules, exit if you reach your profit target. Okay, so we talked about profit targets. A conservative strategy would be to take profits at 10% of invested capital, close the trade, and roll out further in time. That would be the most conservative approach. I'm taking a little bit more aggressive approach and letting things run a bit longer. You have to, trading is a lot of decision making. It's decision making every day. Every time I look at that screen, there's decisions. And so one of them is your profit target. And you got to decide for yourself what you want that to be. But, anybody, if you can make 10% in a month, you're doing great. So anyway, and when you take it off, roll out farther in time. If you close a trade out and you're going back into the same expiration, you're really not doing any risk mitigating. Yeah, you might be putting some money in the bank, but if you would want to roll out in time if you're putting on a new trade after closing another one down. A more aggressive strategy would be to hold closer to expiration, but my rule is I like to be out by 30 days to go. Now, some traders do push this, and there's a lot of money to be made in the last 30 days, but so often when I have done that, I've seen them blow up on me. And so we want to avoid the blow ups and bank that money rather than trying to be a superstar. Yes. Yeah.
The question is, when you roll out, would you roll out at the money?
Yes. The question is, if you close a trade, where do you put your new one on? And yes, the new trade, we would put it on at the money because that's what would give us a roughly delta neutral trade for our new trade. And so, when we put on a new trade, we're basically starting all over. No. We're moving on out. We're repositioning on top of the market is what we're doing. We're really closing the old trade, starting a new one. And that was part of my goal with this whole strategy, was to come up with something that was friendly for Thinkorswim. A lot of traders use Thinkorswim. I use it. I wanted something, there's a lot of different strategies out there that are more of a campaign type trade where you're doing this and you're doing that and you never really know what your P&L is when it's all said and done. I wanted something that was Thinkorswim friendly, and this is. And so when you roll out in time, you're closing your old trade, you're putting on a new trade. So you'd follow the new trade entry rules there. And like I said, a more aggressive strategy would be to hang in there for more money. But, if you can make 10% in a month, you're a superstar. So, there's no prizes for blowing up your account. And I talked a little bit about most aggressive management rules. We already talked about some of this. These were some thoughts I had there. Closing the trade is a day-to-day decision-making process, weighing your delta theta ratio, considering the position under the profit tent, and any technical analysis, which is really beyond the scope of this. But clearly, if we're at the top of the market, we can't go too much farther, so you might consider that in your decision-making. Similarly, if we're at the bottom of the market, sure, we could go lower, but any technical analysis might help you lean these things one way or another. And let's see, consider taking profit. Okay. If you're ever unsure of the market, close the trade. Take your money off the table. You can't lose it if it's not in a trade. Let's see. Okay, this is what we already talked about. And a little bit, this was back to Brian's question, and this is really, sure, there's opportunity for fine-tuning this, but this shows the term structure of volatility, and exactly what that is, your short leg and your long leg both have a unique implied volatility, which is the how the market is pricing in risk moving forward. Implied volatility is a forward-looking number, and it is basically an analysis of how much risk traders all over the world are pricing into the market. So if we're all worried about New York City getting nuked, the options are going to be real high. If everybody's happy, volatility is lower. And so let me see. Short-term contracts have lower IV compared with long-term. Anyway, I think this is all stuff. Footnotes for further study. So again, I've got my link to my 60-40-20 butterfly presentation. It was pretty well received. I made a lot of money on that strategy over a couple of years, but I have had better luck with this this calendar spread lately. Also, Ron Bertino has a discussion on weighted vega, which would be good for further research. Some of you are probably familiar with that discussion. But in a nutshell, there's some possibility that the vega numbers in your trading platform are not very accurate. And I would agree with that, but I don't have a good solution for that. And anyway, and Brian Johnson has a great book on hedging and risk management. And I really haven't gotten into that, but if you'll notice, there's always the chance the market could implode, fly off the bottom of your graph, and all of a sudden you've lost a lot of money. And so I would recommend all traders to get that book and read it and apply some hedging strategies to your trades. And I guess that's all I've got.
Okay, Will had a question.
Weighted vega, what is that?
Okay, weighted vega is, I'm not sure I can really explain it. Can somebody else?
Well, there's a vega for one leg and there's a vega for the other leg. And a weighted vega refers to applying some weighting factor to those. However, Brian is the expert on this. And by the way, could you go on, Brian? Lots of time. Could you go on after explaining weighted vega and ask a few other questions or make a few remarks of your own to get a little dialogue here going?
The weighted vega concept I actually call true vega. So the typical vega that you'd see in an options platform is the Black-Scholes vega, which basically, as Mark said, assumes that implied volatility increases or decreases in a parallel fashion. So for example, if it goes up by 1% for a 30-day option, it also goes up by 1% for a 60-day option. But as Mark pointed out, it doesn't work that way. So the way I do the calculation is I've come up with a formula which is based on, it actually works for a large number of securities, not just for the SPX. But it basically says it calculates the vega for a 1% change in a 30-day option, and then it calculates a corresponding change in a 60-day option, which would be less, in a 90-day option, which would be less. And then for a 9-day option, for example, it would be much more. So basically, it is a curve that reflects the fact that short-term options change much more rapidly than long-term options with respect to volatility. So if you take that weighting, if you will, a higher weighting on shorter dated options and a lower weighting on longer dated options, what you end up with is a weighted vega or a true vega calculation, which basically says what happens, the way that I weight it, what happens if the 30-day implied volatility or the VIX changes by 1%. You're then able to calculate a true vega, which is also called a weighted vega as well, which gives you a very good estimate of how your strategy will change with respect to your profit and loss line. The Black-Scholes vega is higher for a longer dated option because, in effect, instead of changing, let's say, the implied volatility for a 30-day increment, if you've got a 2-year leap, you're changing 2 years worth of volatility, which by definition would have a much bigger effect on that option itself. But as Mark pointed out, it doesn't change by the same amount. It changes by a factor that's much less. So for example, if you have a 30-day option, the implied volatility spikes by 10%, you might only see 1 or 1.5% move in the implied volatility for that 2-year option or the 2-year leap. As a result, the Vega is substantially, the Black-Scholes Vega is substantially overstated with respect to the longer term options, and it's understated with respect to like a weekly or a 9-day option. It would be dramatically understated. So in effect, the Black-Scholes Vega assumes that all that term structure volatility moves in a parallel fashion, which we know is not correct. So even if you start with some kind of modification to increase the level of movement with respect to the short-dated options relative to long-dated options, you're still better off than just the pure Black-Scholes calculation. And it really goes back to the point that Mark made before, in that when implied volatility is extremely low, that means the short-term, kind of the realized volatility, some people call it statistical, some people call it historical. By definition, that might be, let's say, 7 or 8% in the SPX. The 30-day implied volatility, or the VIX, might be 10, 11, 12%. And then the 60-day option, I'm sorry, the 60-day implied volatility or 90-day implied volatility might be 14, 15, 16%. So in essence, that's the mean reversion concept that we talked about before, that even though statistical volatility is extremely low, market participants are expecting volatility to increase going forward, and they price that into options, which is why the implied volatility for the 30-day is higher than statistical or historical. It's higher yet for 60 days. It's higher yet for 90 days because the market is pricing in mean reversion. Conversely, you go back to 2008, statistical volatility at the time, meaning what the realized level of volatility was, let's say over the last 30 days in the crisis, might have been 90%, 100%, but the 30-day implied volatility was probably only 70% at the time. So then the curve is inverted, or you're in backwardation, if you will, and the market participants, even though volatility was extraordinarily high on a day-to-day basis, the market participants were anticipating that the curve or implied volatility would go back more towards the norm. And hence that would be an inverted curve, if you will. But that's predictable. I mean, that's understandable. We know that in effect in advance, so it just makes sense to account for that when you're calculating that Vega estimate, especially when you calculate or when you're trading time spreads, calendar spreads, diagonals, anything that incorporates the fact that have 2 different expiration dates. It's much better to assume or calculate what that overall level of Vega risk is as opposed to the Black-Scholes version. How would I calculate the weighted Vega or the true Vega? What I've calculated, and I've written about it in several of the books that I've written, is that basically there's a curve that looks like a decaying function, if you will, that towards the 9-day option, if you will, you got a multiple that's about 1.7, the 30-day volatility. The 30-day volatility is 1.0 by definition. And then basically it slopes down to approximately, let's say about 20%, 15 to 20% by the time you get down to a 2-year option, if you will. That curve is relatively standard, ignoring earnings volatility, but that curve is relatively standard across almost all asset classes, meaning that decay function is standard across all asset classes, mainly because mean reversion is consistent across all the different asset classes, if you will, meaning the market participants assume the implied volatility will revert to the mean. Granted, the mean is different for every asset class, but that level of mean reversion is built into when you trade options on gold, on crude oil, or on anything else. You're going to see that same decay function with respect to shorter dated options having a much higher exposure to changes in volatility than longer dated options.
Is there any validity anyway, I mean, over any extended range to any computation? I mean, you take a weighted Vega, that's a point estimate, I assume. It assumes a change in volatility at the current market price without the market moving. In reality, the market is going to move big time. So how much validity does it really have, that point estimate?
The way that I think about it is that weighted weighted Vega calculation I use to actually look at the money options. But if you want to look at the effect on out of the money or in the money options, then you need to overlay on top of that the vertical skew function, which is obviously much more complicated, if you will. But in effect, that point estimate is still accurate as long as you're still talking about the 9-day, 30-day, 60-day. That isn't going to change just because the price level in the market changes. That actually is relatively consistent. But the fact is you're going to have an option that's going to go from at the money to in the money to out of the money, and then that's moving up and down the vertical skew function, and that's like a fourth dimension, if you will, of option trading.
So it's a wild, wild number that you would have for sensitivity. So how much use is it really? I mean, let's suppose you have a big move. Does Vega mean anything? Does weighted Vega mean anything?
All I know is that weighted Vega is much more accurate than the Black-Scholes Vega. So I'm not saying it's right or wrong. All I'm saying is that it is many times better than an assumption of a parallel shift in the term structure of volatility. Is it perfect? No. I mean, are we making money simply because we're forecasting it within 1%? No, but I know it's much more accurate as a measure of risk than the Black-Scholes Vega is.
Could you repeat the question, please, Brian?
I
They
don't work
even
or
understand it themselves.
I don't work at Thinkorswim, and I can't answer for them. But
I think some of the other options trading platforms, which have it cost money, you have to pay an annual subscription, do have these sorts of concepts built in.
yeah, I've actually talked with OptionView, and I use OptionView as opposed to Thinkorswim, if you will. And there's basically a new owner that's recently bought out the old owner, if you will, at OptionView, and I anticipate within the next year they'll probably incorporate a weighted Vega calculation, if you will. But it's something that's actually relatively easy to do yourself, as long as you can just calculate what that decay function is, which is a simple exponential decay function, or just take it out of the book and then apply it to your own securities, even in a spreadsheet. It would be much more accurate than assuming that everything moves by a constant 1%. And you could fine tune it. I mean, as Mark continues to trade every month, he would get a sense of this, but he could actually go back and look at how much the VIX changed. So the VIX changed by 5%. The Black-Scholes Vega said it should perform like this. How did it actually perform? And you could just fine tune that decay function over time, and it would be much more accurate than just assuming everything moves up and down by 1%, which we know is wrong.
Another answer to your question is why don't they provide these other calculations is that Black-Scholes is well defined, and that's the word everybody knows. And so they're just doing that because that's what it's called. And a lot of people don't even know of the other calculations. They don't even realize that Black-Scholes is for European options, not American options, things like that. So,
Well, Brian is absolutely right on with what he said about all this. And I'm not taking anything away from his explanation. It's very good and better than I could do. But I don't want this to scare people who are interested in this strategy, because I'm not sure you have to understand all of that to really have some success here. The long time to expiration gives a certain comfort level in this trade, and because volatility is mean reverting over time, your legs will bounce around in their volatilities, and you'll see that reflected in your profit and loss. And that comes back to my advice to watch your delta theta and keep an eye on your trade that way, rather than being freaked out about fluctuations in the volatility of your different legs. So.
Yeah, to second what Mark just said, you don't need, in this case, you don't need true Vega to actually put on the trade. You don't need true Vega to take off the trade. You don't need true Vega to weight the trade. You don't need true Vega to make an adjustment to the trade. But if you want to understand how the trade is going to perform in the future when volatility changes, that's when true Vega is very useful, if you will.
Absolutely.
Yeah.
Do you have any other questions or points you wanted to make, Brian, before we move on?
Not at this point, but I'd be happy to chime
Okay,
in
good.
if
Thank you.
something
Brian
comes up.
is the author of several books, and so people can appreciate that we're always interested in hearing his opinion. And we got some other people here in the room who have questions. And also, I'd like to bring in, and I know Mark would too, we discussed with him, remote users. We have people who join this group from all over the country from Aramir. And a lot of them are online remotely in other cities across the world, really. And if you have a question, you're remote, try just turning on your mic and asking it. Raheem, you had a question. Can you turn on your mic? Or I can probably turn it on for you and ask the question.
Expiry.
Okay, we'll try to answer that question. So this is a double calendar. So the lower calendar is centered where the peak here is. And originally, the upper leg of this calendar swooped down similarly to the way the downside is here. And that would have been your trade. And so the pricing of the market threatened the upper end of that calendar, and so we added another one. But if you could imagine kind of, I'm assuming you can see my cursor, it would have originally swooped down about like that, and at some point we got worried about it and we doubled it up. And so the upper calendar is centered where this upper peak is, so we may not have doubled up till we were at that point, because the rule is to put them at the money. So when we started, at the money was way down here. At some point during this trade, at the money became way up here. And that's what the combination of the two looks like.
Does that answer your question, Raheem? He says here, so it breached the expiry break even? He typed.
Yes.
Yes, it did, is the answer. Is there anyone else remotely? We'll come back to questions in the room here. Don't worry. But is there anyone else remotely who has a question? You can turn on your mic if you wish. Let me see. Who here can we get? Francesco, do you have a question? Well, just come back to us later if you do. I think there are other questions in the room here now. Did you have some questions?
Safety trade, volatility percent. And if you've ever looked at your trades compared to what the particular volatility percentile was on when you put them on and how successful they were. In other words, they love to trade when the percentile's over 50.
Well, okay. Tasty Trade mainly focuses on credit spreads and Vega negative trades. They don't really do much of these, although Liz and Jenny was doing them for a while. But Sosnoff does not like this, and I don't know why. It seems like a logical answer to a market that likes to send us a lot of volatility shocks, and so they've worked very well for me.
Versus the volatility.
Oh, well, yeah, and back to your question about the IV percentile, I'm just trading the SPX, and it has pretty low IV percentile typically. So I don't really worry about that too much. This is kind of a long-term trade. If you were trading real close to expiration and trying to get a volatility crush on your let me think this through. Yeah, I don't worry about that too much.
has some comment. Okay, Michael has, let me go to Mike.
Well, looking at the screen at the moment, you've got a double calendar and the T+0 line is elevated compared with previous slide.
Right.
And is that because you put more capital into the system?
Well, no, this is projected out in the future. If you'll look at the date down here, 10/31. So this is the end of October. So this would have been a trade hypothetically put on today or yesterday and projected forward in the time. So it takes a while of being in the trade for this T+0 line to lift to a height like this. So I hope that answers your question.
Now you talked about the delta theta ratio and adjusting to keep it under 30%.
Right.
The gears that you use to adjust, do you simply just take a calendar off? Like suppose you have a double, you take maybe just one lot off the top.
Yes,
one lot off the
you
bottom?
can adjust them incrementally that way. If you have a double calendar and your Greeks are getting out of whack, you can take a few off one way or another. If it's too delta positive, take some of your positive trades off or add to your delta negative trades. And so, yes, there's potentially minute adjustability with a double calendar that way. So, but you know, I usually just take them on or take them off. Is typically what I'm doing. They behave themselves for a long period of time. Most of these I'm in for a month or so, and so not a whole lot of drama along the way.
You say you haven't had any of these blow up on you unless you held them past.
I have not had any
Closer
of these
to
blow
30
up
days?
since April.
You say that was because you held on to it too long.
Well,
have to
some
back
of these I pushed the rules a bit. You know, I had one that I took 20 days expiration, but I've not had any of them blow up since April when I started doing this. And I've made 100% on my money since then, by the way.
Wow, fantastic.
Dan has some questions.
Yeah, another style of calendar I've heard about, I haven't traded it, is maybe a skip month where you are not, say, your 60-day and then go out even further, or go 30-day, skip a month, and then go to 90.
There's all kinds of variations on these. There's a fellow that presented for us before named Himanshu, who is, I think he's Korean or something. He's done a lot with buying an option like 2 years out, and then he'll sell weeklies or monthlies against it and roll it and roll it and roll it. There's all kinds of variations. I wanted something that was platform friendly. I don't want to have to look at a spreadsheet to figure out my profit and loss. I want to look at it on my phone and see, oh, I'm up or I'm not up. And so I haven't done any of that. But yeah, there's all kinds of potential variations.
The idea there, I think, was to, whenever, instead of putting on the second calendar, to roll out that first near-term calendar out and pick up some additional premium.
Right.
That way.
Right. You can do that. Yeah, there's all kinds of different ways to handle that. But again, I wanted, you know, my concept was put it on, take it off, and I want to be able to look at the platform without a bunch of figuring and go, yes, I'm up money. Yes, I'm in trouble. Whatever. I want to be able to look at the platform. And so if you buy an option way out and you're selling multiple times against it and rolling and doing all this, it's a little hard to track. Not impossible. Surely you could do it with an Excel spreadsheet or maybe another trading platform, but you know, I wanted something thinkorswim friendly that I could do in my IRA, and so this fits the bill.
Thank you.
Sure. Got a question up there.
Wow. Okay, we go into the back. Let me get the mic so we get it.
Hey, Mark, Luis here. Sorry to dumb down the conversation, but please take me through the delta theta ratio. What's the magic of that 30% threshold? I'm not sure I understand what it means if it's above 30. And because this pair are two legs, how do you calculate that ratio as each leg has its own delta and theta?
Okay. The delta, when you put this on at the money, your delta will be very close to zero. Maybe it's 1 or 2 plus or minus, but you're very close to zero. And so delta, you can think of delta as a measurement of your directional risk at any given time. If the market moves, your delta is going to change. A positive delta means we really want the market to go up. A negative delta means we really want the market to go down. And so this is not a textbook definition, but you can think of a delta as a measure of your directional risk. Theta is what you're being paid on the trade. Now, these are positive theta trades. So with the passage of time, your T plus 0 line is rising, and that shows you graphically what's going on with your theta, and you are making money over time because it's positive theta. And so the delta theta ratio simply shows us it's comparing a measurement of our directional risk to what we are being paid to take that risk.
Just show them on the chart there where those numbers are.
Okay,
right up there
on the
screen.
chart, I'm looking at this line down here. Well, he's not seeing the whole thing, but this is the price slices down below the graph. There we go. So I'm looking at this number here, delta, and this number here, theta. And this is these are composite numbers. Each leg of your trade has its own unique Greek, and this is the composite because your let me think, your short leg is positive theta, your long leg is negative theta, and so your this trade leverages the time decay differential between your long and your short leg. So theoretically, if you go further out in time, let's just say whatever, 2 years out in time, those options are going to be decaying very slowly compared to something that is, say, 60 days to expiration or even less. So, so we're leveraging the time decay differential, and this is how we do it. The price slices down below on your analyzed graph in Thinkorswim, delta to theta, and in this case, our delta is 1.38, and our theta is 40.25. So, yeah, I do a little rounding. We're basically like 1 to 40. So, right. So you got a very small percentage there. It's
the theta is the money you earn every day, and the delta is the risk that you won't earn it anymore. So you just want the ratio to be as favorable as possible.
Because we're essentially bullish and bearish at the same time. And so how do you make money if you're bullish and bearish at the same time? So, you buy Apple stock and you short Apple stock at the same time, well, you're not going to make any money that way. But with options, you can because of the time decay involved. So we're basically long and short, and we're making money on the time decay of the options contracts.
Got you. So now help me with the 30%. Let's say I'm not sure I understand. What if the ratio was 50%? What does that mean?
Okay, as you get farther on this graph, let me see. I could really show you one on the platform, but if this is this vertical line is the current pricing of the market. So if the market moved way up here, your Greeks would obviously change, and so at some point you're getting too far up here. Like, say all of a sudden the market is up here. Well, we have no. I mean, you might apply some technical analysis or something and say, oh, well, we're due for a pullback and we've still got 50 days to go, so let's wait it out. But if you were just managing according to the Greeks and the chart, and you're way up top, and you have no confidence that we're ever coming back to the profitability zone, well, you would want to either close the trade down or make some adjustment. And so way up here and way down here, these numbers are going to get way out of whack. And so by looking at this ratio, this is a way I've found that I can monitor the trade from my telephone when I'm out goofing off and not sitting at my desk. It's worked pretty well for me. I know it may not be the most scientific thing, but it's a way to keep a handle on your trades.
I think Brian may have an explanation.
You can think about the delta theta ratio as a risk return ratio. The level of risk going to happen as you move to one extreme or the other. Delta is going to increase, theta is probably going to decrease. So in the risk is going to increase, your return.
Brian has an excellent book on risk-return ratios too, which I would highly recommend that. I learned a lot about the Greeks from reading Brian's books, and so I would recommend everyone get the books and read them. They're a little bit dense. I've had to read them over and over. But you'll learn something. You'll probably learn a lot, so I highly recommend them.
So you just have one of these trades or campaigns on at a time, right?
Oh, I have several. I've got multiple accounts I manage, so I've got several.
Okay, but each account only has one at a time?
Typically.
Typically? Okay.
Yeah.
And can you just kind of run through the way you go shopping for options? Like, how do you know you're getting a good price?
Well, that's a good question. Let me see if I can get back to my screen here. This is something kind of goes back to what you're thinking and ties in some of our discussion on implied volatility. This is a feature in Thinkorswim that is below the option chain. If you'll go to your look option chain, this is down below, and it's called product depth. And so what I've done here, you can make it show puts or calls, and I'm just mainly interested in the puts and the options, and I have you can show all the strikes, but since we're mainly concerned with at the money options or things close to the money, I'm just going to put that on 4. So we're getting 4 strikes right around where SPX is trading, and SPX closed at 29.84 today. So if you could 29.84, it's right around in there. It'd be nice to be able to put a price slice there, but it doesn't have that feature. But it just remember that vertical line there, and what I've done here is go into the different options. So these are your monthlies, your different option series, October, November, December, moving on out in time. And this gives us a graphical representation of the different volatility levels of the at the money options with each series moving on out into time. And across the bottom, I don't know if you can see it. There you go. Across the bottom, each one is color coded. So the implied volatility of October is much lower than November, and then December is even higher. January, not much higher than December. Then we have February and March. And so this ties in with our discussion of backwardation and implied volatility. And I've used this on individual stocks. You know, I haven't fooled around with this much with SPX because it just seems to work without a lot of drama. But if you were to put in something with earnings coming up, like I happen to know Costco has earnings coming up, and do the same exercise. And let me see. So we got the monthlies moving on out into time, and you can see this. What is this purple line doing way up here? Its implied volatility is jacked up compared to all the other option series. And so I can look down here at the bottom and go, oh, that's October 18th. I bet they've got an earnings call coming up. And so you can also look up here on your option chain, and these numbers on the far right here, these are your implied volatilities for each. These are the at the money implied volatility for each option series moving on out into time. And so you can see that October 18th is elevated among, in comparison with these others. And so if I wanted to put on an option, a earnings play on Costco, what I would do is sell the October 18th options, and then I would move further out in time, probably November with 51 days to go. So I'd buy November, sell October, and that would be a way to take advantage of this volatility crush, because after the earnings announcement, assuming price doesn't move too much, this implied volatility is going to drop way down here. And so you can leverage that. I'm not sure I even answered your question. Did that answer your question? Okay, well, here, let me just set one up here. So SPX. All right. You know, okay, here's what I do. I'm going to put on a new trade, and really, I'm just selling the option series. Okay, there's no weeklies in here. I'll show weeklies. All right, I'm just going to do one at 50 days, although normally I would try to go beyond 60, but since I don't know how to turn on my weeklies here, I'm just going to do it at 50 days. And so I'm going to click right here on the at the money, 29.80. So SPX closed at 29.84. Let's just assume the market's still open. I'm going to click right there on the 29.80 bid, and it puts up down below here. Let me pull this up here. Okay, it puts up sell the 29.80 put for November. Then I'm going to close November, and I'm going to go out to December, and I'm going to hold control down and hit the ask on the 29.80 put there. And so you see I've got a pair here. So we're selling November 15th, we're buying December 20th. And so I'll look at my risk profile, and that's the trade. And so I like to expand it out to see a few more of the numbers. Let me just navigate this thing around. I want to see each 10 going up and down the scale. And let's look at our price slices. Make sure your padlock here is open. Okay, so that's a new trade right there. And so that's just a one lot. So a one lot trade would cost you, you can hit right click, confirm and send to see what a one lot would be, about $2,400. The numbers are bigger if you increase your lot size. Say a 10 lot would be 10 times that, $24,000. You know, I don't really know.
One way and kind of slowly.
This is your midpoint price. I'm typically just firing these things off at midpoint. You can, I'm sure there are ways to refine the process. Sometimes I'll put it in 15, 20 cents below midpoint and see if it'll trigger. You know, if you don't get the perfect fill, this is a positive theta trade. So in a few days, you'll be up money, even if you didn't get the ideal fill. But we don't want to fire them off at market. This is showing us a midpoint price. And so if the market was open now and I had decided it was time to get in, I might put this on at 24.10, see if it triggers. If the market's moving away from me, I'll start to up it or you know, or wait till it comes back down. So anyway, just fire it off. Don't worry about that.
Okay, hang on. We got, yeah, hang on. We'll get to it.
Okay, so once you put this trade on, then you watch your delta theta ratio
Yes.
and keep an eye on that, and then you wait till the short option expires, assuming your ratio is below 30%.
Yeah, we don't want to wait for that. We want, if it's 30 days to go before expiration on your short leg, we're getting to the point where you need to probably take it off.
Okay, and then once you take it off, you take off the long option too.
You take off the long
Okay,
option.
you don't wait.
Start all over.
Okay, okay.
Start all over would be
Okay.
my approach.
Some other questions?
Okay, I've got 3 price slices here. Let me get rid of. Let me get rid of. So a lot of people will have a vertical line, say 5% up, 5% down. But to simplify this, I'm just getting rid of our extraneous price slices. And so, yeah, and so this is showing what the Greeks would be right here. So let me just drag this up. Notice how our Greek numbers are changing. So say the market's on a tear. We worked out a deal with China. Things are going great. Whatever the reason is, and so we're up here all of a sudden. So now look at our delta. Our delta is negative 29, which is telling us we want the market to go down. Our theta is 94. So we're getting to be 30%. You know, we're a bit past it actually. So in this case, if I had put this on and I was sitting in this trade, I would go on and double the thing up and add the second butterfly on top. And it works the same way on the bottom too. Say something bad has happened in the world or Trump tweeted and we're down here all of a sudden. So now look at our delta. Our delta is positive 53 and our theta is 76. Well, we've blown past our 30% rule. Now we're still under the profit tent. There's still a chance this might be okay, that we move, that the market reverts. Oftentimes the market overreacts to things too. Like the Saudi oil thing just last week. Oil shot up big. All the suckers are like, I'm buying oil. And I shorted it and made a lot of money because the market overreacts. And so oftentimes, if it goes way down, it will come back to you. But you can't really use that as a, that's really beyond the scope of just the mechanics of this. If we're down here, I would add up on the bottom side, double up. Yeah, it will change over time. And like Brian was explaining, that number is, yeah, a little squirrely, may not really be all that accurate, but let me just simulate the elapsing of time on this graph. I'm gonna click forward the days one by one. So this is, there's October 14th. You can see our T+0 line has lifted across this whole range. And all of a sudden, we're up $2,900 on our investment of $24,000. So we're over 10% already on that. So you might just take that off and do it again. You know, we see this graph up here, and yes, theoretically, if you held this thing to expiration, well, yeah, you might make 30,000 or you might make 20,000, but usually something goes wrong before you make $20,000. So, you know, if you can make 10% on your money, be happy that you're beating everybody on Wall Street. Put it in the bank, roll the thing out, and keep your risk low, would be my advice. It's all right. Correct.
So this has got a short option, and we just went through a little thing where you explained that the short option is going to react more to events like Trump tweets or Saudi oil than the long dated one.
Right.
So is the fundamental reason conceptually why this is less sensitive to those spikes because you only have one short option right in the center there, or is it some other factor?
You know, it is a complicated
butterfly
thing to answer. Yes, okay, let's just say you're in a trade and Trump has tweeted and it's affecting your short leg volatility. So your short leg volatility is you can think of that as the pricing on your short leg. So the pricing on your short dated option has gotten more expensive than what you collected for it. That could actually hurt you a little. So in my experience, without doing the math and digging real deep into the Vega number, is that these things seem to be more Vega neutral than anything else. I haven't really, you know, on individual stocks, I have seen cases where the whole graph rose up and I made a bunch of money real quick. Usually not happening on the indexes. I would think of your Vega as a bit more Vega neutral. Say you're in one of these and we do take a plunge to the downside. There may be some lifting of this T+0 line here to keep you safe farther down. So just like right there, for example, on this trade, you would be drawn down $1,200, $1,237. So this may not be modeling your volatility exactly because their math is faulty. You may see a little bit of lifting in this line on the plunge downward, which will help you a bit. But if we blow it out down here, you know, all bets are off, and you should have closed the trade or doubled up or done something. So the changing volatilities of these things are hard to wrap your head around because you don't really know which way it's going. But say that did happen and your short-term volatility spiked, and it's hurting the profitability of your trade for the moment, give it a couple of days, it usually calms back down and comes back into profitability, as long as you're not blowing out the bottom of your graph. I've found these things, I know you've got a day job, and a lot of people do. I've found these things very compliant with this. There's usually not some situation where I'm away at lunch and Trump tweeted and I'm like, oh my gosh, I've got to go do something. They're really easy to trade in my experience.
Actually, I think Dave had a very good question. I think the answer is actually a little complicated, but it just occurred to me listening to Mark's presentation. But if we go back to the butterflies that we used to trade, or Mark used to trade, you actually have two volatility bets in the same direction. You are short Vega or even negative Vega, and you also have a negative gamma. So basically, if you have a large move in price, you lose because of gamma. In other words, you have a exposure to a big change in realized volatility, but you also lose in implied volatility as well. In other words, implied volatility would spike in that situation. In this case, if we ignore the term structure volatilities here and we just say that we have a positive Vega on the trade, but we still have the negative gamma, which we do, in essence, you have kind of a built-in hedge to some extent. In other words, kind of as Mark said before, if prices go down significantly, you are going to lose because of the negative gamma of the position. But in essence, if implied volatility does go up in that environment and the Vega is accurate, or at least partially accurate, it actually offsets some of your losses. So I hadn't really thought about it. Maybe it's just Mark's great presentation, you know, that brought it out in me, if you will. But in essence, there's kind of a built-in hedge to the trade. I actually looked at it as a contradiction, But it's not really a contradiction. It's actually a way to reduce your exposure to that price movement or volatility change that's built into the calendar spread.
Doesn't M3 have positive vega also?
Say that again.
Doesn't M3 have positive vega also?
Vega, I'm not sure about that. I don't think so.
It's a balanced butterfly. It's not a
I'm not sure about
broken
that.
wing butterfly.
That's a good point. I'm not sure about
I
that.
believe that's one of the advantages, but I could be all wrong. If anyone knows.
Well, the base structure would be negative vega, of course, but maybe with the long call in the M3, I'm not sure on that one.
A lot of the delta is coming. If you go to neutral delta, you're achieving it in large part with the long call, which is not just deep in the money. Anyway, it's just a minor point.
Delta neutral. So how does negative gamma come into play with the delta neutral situation here?
It doesn't stay delta neutral.
Well, delta and gamma are two different Greeks. So it starts as, if you do it at the money, it starts as a delta neutral trade. But even initially, when you put the trade on, it is significant negative gamma. That's correct.
Well, that's true, but it becomes more negative gamma as you get closer to expiration, and that's part of my reasoning for trading farther out in time. Is your gamma number is smaller, and that's graphically represented by the slope of this curve. If you notice, I'm assuming you can still see this. You can see the gamma is negative 0.68, and as I advance in time, that gamma number is getting bigger and bigger in response to the slope here of this line. And the reason that matters is we can say we do have a gap down. Well, if this line is real flat and we gap down, you're not riding much of a slope, but the slope gets steeper and steeper, and at expiration it would be like this. And so we don't want to have like a situation where we lose $20,000.
What gamma says is what will happen to delta on a market move. And it's saying it's going to go, if you have a high gamma, you're saying delta is going to go crazy. So it's not that you're worried about what delta is right now. Gamma is telling you how bad will delta go. And if you're high gamma level, you're saying delta will go crazy.
Yeah, gamma is essentially the reason that delta changes, and it's also the reason that that graph is basically downward sloping at the extremes.
What? Base step. Oh, let's make this number a bit bigger. Every 10 days. So what is this telling us here? This is our gamma as we get closer to expiration. Expiration being November 25th would be. I don't know what this is telling us really. Can you explain that? Okay. There we go. I think some of those have gone beyond expiration is what the deal was. So
I think that kind of shows your point. Where the closer you get to expiration, the
Yeah.
more gamma increases.
So you're dealing with a much bigger gamma number. So like even, let me see, let's say that this white line, which represents November 6th down here, significantly more negative gamma than you got up here at, say, the current, well, I've got this projected forward to October. Let's go to today. Okay. So that just shows how gamma changes. And so that's part of the reason you want to get out with 30 days to go. Now, yes, there's a lot of money to be made in the last 30 days, but a lot of people go bust chasing that money. And so my approach has been to go farther out in time. And I'm experimenting with some that I'm putting the short leg at 90 days and the long leg 30 days beyond that. So, yeah, don't think you're going to trade till expiration. The whole trade becomes more dangerous in
He was saying
all kinds of ways, but the gamma is a factor for sure.
Raheem had a question. He said, you should test this in 2017. It was brutal. 2014 and 2015 were easy.
Okay.
Do you have any comments on that?
I would have to study the charts and think about that one.
Raheem, why don't you turn on your mic and say a few things about that if you want, or else because type in. Who? Let's see. Do you have another comment? And who else has some experience trading calendar spreads? Have you traded many, Dan? No? Nobody has traded calendar. So this should be a very edifying.
I've traded them against equities a lot.
Okay, equity. So what has been, this is Tom. So what has been some of your experience with calendar spreads?
I did it for about a 6-month period. And you roll, it moves and you roll out. And you could even roll another time, end up with 3 of them.
So it's pretty hard to keep up with the market.
Not really, but I would comment on Mark's question about not being platform friendly, because you can't figure out what your profit and loss is as the trade gets modified.
Right.
There's the way in Thinkorswim to account for all that.
Oh, I know
okay.
There is. It's just, to me, it's not all that user friendly. I mean, yes, you can copy the trade and pull it back in and all that, but
okay.
I wanted to be able to look at my telephone.
Well,
really,
yeah, I can't do that.
And you can't do that.
So did you find a way that you were satisfied with, though, in the end, Tom, in terms of Thinkorswim?
Well, you mean just trading calendars?
Yeah, in other words, we're saying here that, yeah.
Well, at the time I was following the profit and loss using an Excel spreadsheet, which is, you're right, that's a pain.
Yeah.
But, I don't remember why I quit doing it. I know I was doing it on a shorter time frame, and I was using stocks instead of indexes. And it was labor intensive. I had to stay on top of it. And I was only going out like a month using weeklies. So it was quite labor intensive.
Well, the short time frame is a big gotcha. I like, I've traded Amazon a bunch, all different ways, and made huge money and lost huge money. and
I'm excited about this.
And the
the
volatilities of individual stocks move around more, actually. Yeah, the volatilities in SPX move also, but the magnitude is much greater in something like Amazon for sure. And probably a lot of other stocks have that too. And it's, implied volatility is a measure of the market's mood regarding that instrument. So, people get all excited about Amazon. There's all kinds of news about it. Trump tweets about it, and the volatilities go crazy.
Oh, yeah. Do you talk about, you just have one of these on? Have you thought about overlapping?
Well, I'm playing with laddering them out in time. I've got one. I've got November, December running right now, and then I've got December, January also. That,
But you do it mid-cycle?
yes.
Okay.
So there's a lot of potential for tweaking the system like that. And yeah, I think that's a better approach than having everything at one and then having to start all over. If you can stagger them out in time, yeah, that's certainly a good idea, I think.
Thanks, Tom and Mark. Well, I guess we're almost out of time. Oh, I'm sorry. Is there another?
Two more.
Okay, hang on a sec. Let me get you there. Get it on the mic.
Experience in trading this since April, and you open up your trade, and then the trade goes against you, and your delta theta ratio tells you, okay, I'm going to double down at this point. Have you ever had to continue to go further in the same direction, and then all of a sudden you're faced with an adjustment at that point? Okay. So,
well, you know, the possible solution would be to add a third tranche on there, but usually what I would do is take off the upper one and roll it down to cover that zone.
did you have that experience at all?
No, I really haven't. I've had a few scares to the downside, but I left it alone because I was still a long time to expiration, and I'm following some technical indicators and things that gave me some indication the market might revert back to where it was, and that's worked out for me. Oftentimes the market overreacts. If there's a big gap down, usually we're not far from a big spike up. So hadn't been too much of a problem, but it could. It certainly could.
Okay, I think we're about out of time. Let's have a really nice sound for Mark. Mark, are you coming over? Are you coming?
Sure.
Mark is coming over to the Family Bar Grill. So if anyone wants to chat a little bit with Mark, or just chat with any of us, come on over. Right, it's just a couple of blocks, actually, just within Cameron Village Shopping Center, over toward Oberlin, just a little bit. We can a bit of time. So I hope many of you will come over. Ask us if you need directions.